Hi everyone, Stacy Whiter here on behalf of Campus Mortgage with part 3 of a 3-part video series on mortgage insurance on FHA loans. Now just a quick reminder before we get started, this video is for informational purposes only and should not be considered legal advice or used in place of FHA guidelines. Also, this video was issued on May 15th, 2018, and the information contained in this video is subject to change without notice. In part 2 of the 3-part video series, we went over in detail the upfront mortgage insurance premium and how it's calculated. For part 3, we're going to talk about the annual or periodic mortgage insurance premium, where to find it, how it's calculated. So the annual mortgage insurance premium, just like the upfront mortgage insurance premium, is located in the Appendix 1.0 of the FHA Single Family Housing Policy Handbook. Now again, I'm sure your loan origination system already has this calculated in, but this is the actual source where you can find it. Now, the annual mortgage insurance premiums are listed on the same document that I showed you in the previous video, but there's more information here, so let's take a look at this section. And we're going to do this by doing a purchase example. So we can see here at the top that the annual mortgage insurance premium, if you can see here, it says applies to all mortgages except streamline refinance, simple refinance mortgages used to refinance FHA that are endorsed on or before May 31st, 2009. So remember I showed you the exceptions before, that if it's an FHA to FHA and it was originally done before 5/31/09, they get a discounted upfront mortgage insurance premium. They also get a discounted annual premium. So just keep that in mind. But let's do an example for a standard. So let's say you're doing this loan today. How would you read this? How would you do your calculations? The first thing you're going to want to start with is the term. So you'll start with the term, which means I'm going to go right up here, and it says mortgage term of more than 15 years. Well, this is a 30-year loan, so it would fit into this top category. We would use the bottom category if it was 15 years or less. Now the sales price. So we can see here that is the base loan amount based on what the sales price. Is it going to be less than or equal to $625,500 or greater? Well, we don't need to calculate anything. We know it's going to be less than. So that's going to put us right up here in this category. And we know, again, it's a 3.5% down payment, so even if they were putting down more, it's obviously going to keep us in that same category. Now we can determine the MIP rate. So we know the borrower is only putting down 3.5%. So if we go over here to the right where it says LTV, we're going to find the category that matches. So it's not less than or equal to 90%. It's not greater than 90 but less than 95. It is greater than 95% because they're only putting 3.5% down, so their LTV is 96.5, which means that in this scenario, the MIP is 85 basis points. And how that's calculated, so how you calculate it is you take the base loan amount, which in this case is 226,775. And how we got that was we took the sales price and multiplied it by 96.5, which is the LTV. And then what you'll do is you'll take the base loan amount multiplied by 85 basis points. And the actual calculation would be 0.0085, and then you would divide that by 12 to get your MIP monthly fee. So in this case, it's $160.63. You do not drop the change in this scenario. So it's very clear to see here that in this case, in this scenario, the borrower's monthly MIP would be $160.63, and we got all of this by just going to the calculation rate set by FHA. All right, everyone, that concludes this video series. Thanks so much for watching. For more tips and videos, please visit campusmortgage.org to look for their weekly mortgage video tips designed for all mortgage professionals, including underwriters, loan officers, processors, closers, and post-closers. Have a great day. We'll see you next time. Bye-bye.